Who's getting funded these days?
Such a simple question.
2020, 2021, and maybe early 2022 were massive funding years in venture capital at the early stage. The only time period people were ever comparing this to was the dot-com boom days.
Mm-hmm.
The goal of early stage is figure out if this is working.
Are you aiming for IPO? Are you aiming for this massive horizontal play that is going to be incubated by burning capital for 5, 6, 7 years, right?
Once you get to a certain scale, market share wise, revenue wise, customers wise, however you think about it, you just have a lot more options.
Is there a model that is both investor friendly and founder friendly?
We're different. For every 10 investments we make, 7 or 8 have to be doubles.
Hello, everyone. Welcome to another episode of the Cheat Code and Friends. Today, joined by my normal friends, Justin and Sean. Fellas, what's happening?
Just normal friends?
Just normal friends.
Fuck off,
Yeah.
Josh.
Just basic friends.
Basic friends.
Scumbag
Basic
Good to
friends.
see ya.
Good to see you guys.
Good to see
And
you.
our extra special friend today. I'm really excited about this one, actually. So this is a partner at Noro-Moseley, a big, Series A venture capital firm out of Atlanta. He's a friend of mine and also been a mentor to me in this space. Coming into it after Justin and I were thinking about what we were going to do. This individual really did a great job helping us get our arms around the space and launch. In fact, helped us do one of our first investments together and co-invested with us in a deal. So sure we'll talk about that. But Vasant Kamath, thank you for joining the show. It's great to have you.
We're beyond.
Yeah. So let's jump in. Who's getting funded these days?
Such a simple question.
Well, so, I think you set the stage, Josh. So we're in Series A world primarily. We call ourselves early growth equity. So just for the listeners, what that means is sometimes we'll do Series A, sometimes we'll do Series B, sometimes they won't be called any of those things. I think for us, it's the type of company we're funding and what stage they're at in terms of where they want to go with the business. There's also how they want to grow the business. So we can talk about that in a minute or later, but that's important too from a sort of how you want to accelerate your growth, build the company, that kind of thing. So that's where we focus. I have a broader sort of view of the venture world, having been in it for a while. I think it's probably important to set the stage for folks. So 2020, 2021, and maybe early 2022 were sort of massive funding years in venture capital at the early stage. By all historical, definitions, sort of pales in comparison. The only time period people were ever comparing this to was the dot-com boom days.
Mm-hmm.
In terms
Yeah.
of types of companies that were being funding, amounts that were going into funding, companies potentially going public, and companies selling. So it wasn't just funding that was happening, but there were actually a lot of exits. And exits are great. That's the lifeblood of our industry. And so as a result, a lot of that money was going back into venture, or even more money was going into venture because you were actually seeing exits. But what you saw was a peak of funding and also a peak of valuation. So valuations were at all-time highs. And then somewhat understandably or maybe predictably, what happened is after that, what goes up must come down.
Hmm.
And so 2022, 2023, 2024 have been rougher years from a funding perspective, despite the fact that there are a lot of venture firms and growth equity and private equity firms that have enormous amounts of capital to invest. So despite that, less companies are getting funded. I think a lot of firms are seeing some of their portfolio companies in trouble. And so they're putting money into some of those companies. That's what happened in a lot of 2022 and 23 and 24. I think you were also seeing a lot of slowdown in growth in the software world. So software companies weren't growing as fast. So all that to say, it's a tougher funding environment for sure right now. I think in a lot of respects, you're going back to the basics. So for companies that are getting funded, they have good fundamentals. In Series A stage, they're certainly growing. You know, what we like to see in our world of early growth equity is we definitely like to see companies that are growing, but they've grown in sort of an economically, sustainable way. So they have either sales reps that are hitting quota, or their CEOs are leading sales and doing a great job. They're putting marketing dollars appropriately into a funnel that's paying off from, conversion standpoint. And then they've got a product that people want. And that's easier said than done. But what I mean is, people are not only adopting the product, but they're actually staying. Those things all sound sort of like basic, but they're really hard to pull off, especially as you're growing and getting larger and larger. And so, that's what, in terms of Series A and early stage, what we're seeing getting funded. Now at seed stage, it might be a different story.
One of the mentalities that we see persist from time to time that seems to be hard to get over is that growth at all cost mindset. And based on what you said, it's just not acceptable, right? Like we can't have tremendous burn just at the sake of growth. Are you seeing that with founders that you speak to? And what are some of the ways you've been able to get over that hurdle?
Yeah, look, I mean, I think there's still that mentality in a significant portion of the VC population and the entrepreneur population. So I don't want to say it's a complete shift in mentality. It's that I think in some parts of our world in sort of software companies, that's gone out of fashion. And I'd say for us at Noro-Moseley, that was never really in fashion. So I think we've been pretty consistent. And that means we miss out on some of the big deals, but it's a risk or lack of risk, I guess, that we're willing to take. So I think there are a lot of companies with some more of a venture mentality that are still willing to do that. Certainly, you see that in AI. With a lot of the AI companies that are getting funded, they're getting funded pretty significant amounts at significant valuations, and they don't have revenue yet. It may be guys who came from OpenAI or Google or wherever, but I think those companies are still getting funded. However, I think there are a lot of companies that are doing well that are thinking a lot more sustainably, I'd say.
Yeah, it's interesting because I think venture gets lumped in really as kind of a blanket term a lot of times from the founder perspective. Hey, I want to take in venture capital. And to your point, there's a lot of stratification within venture, but I think there's even a deeper stratification developing in early stage venture, which I would kind of lump seed and Series A together there, to where you're seeing that bifurcation. It's probably a bifurcation that was always there, but I feel like the tranche of like efficient capital, oftentimes verticalized, looking to build a certain towards a certain exit, and maybe that's kind of the main differentiator there. Like, are you aiming for IPO? Are you aiming for this massive horizontal play that is going to be incubated by burning capital for 5, 6, 7 years, right? Like until that commercialization really catches up, versus like the tranche where I think, segment where I think you guys play and kind of also play in that same sphere, which is, exit optionality is much more diversified there. It could be an acquisition, it could be a secondary, it could be private equity. There's just a lot of optionality there that is less focused on hyper growth, but probably more to the point where that we're talking about, less focused on like building this massive disruptive, game-changing organization, kind of placing this huge bet early on that's going to pay off far down the line, and more about like, are we building a great company that is going to develop that optionality along the way? Is that kind of a
Yeah,
fair
exactly right.
definition?
Yeah, so part of our pitch is, you're growing, you entrepreneur A are growing well, but you'd like to accelerate your growth because you see a big opportunity. Our job and our philosophy is to scale you to the point where you have a lot of options, which is what you were just saying. Your options could be, okay, now we see a huge opportunity here. We're going to raise a much larger round. It could be, we're going to go to private equity. It It could be, you know what, now we're relevant to a strategic and we're going to sell for an outsized return. But the point is, once you get to a certain scale, market share wise, revenue wise, customers wise, however you think about it, you just have a lot more options. And that's where you want to be anytime you're trying to exit. So
Yeah, and if you've taken in, I was just going to say 250 plus million dollars, but we're really talking about billions of dollars in capital in some of these like large horizontal plays. Like, I think it's important to note, like, there's not a lot of optionality with that type of a cap stack within a business. Like, you have to have a massive IPO exit, or, it just reduces those
I'd
potential
say
outcomes.
I'd say the numbers even lower, Justin. I mean, I think once you take maybe 75 to $100 million total, that's what you're shooting for. And that's what the VCs are shooting for, right? Those kinds of VCs, those kinds of VC funds require billions, exits in the billions, for the return to work out. So
For sure.
they're usually all embracing that risk, but it's a lot of risk. You know how many companies actually make it to that sort of rarefied air.
Yeah,
It's not
not many these days, certainly.
yeah.
So Vasant, when you
Certainly not in terms of an actual exit. Maybe on paper as a unicorn, but what we care about is exits.
yeah, I was just gonna say, Vasant, when you're that early, obviously when it's not growth at all costs, the makeup of the team's got to be different, right? And how they hire and who they hire. And so, what do you look for? I guess it's different than I guess maybe back in 2020 to 2022, or even before that, in a more efficient model.
Yeah, I mean, there's a friend of mine in the venture world who was doing early stage investing, and he said it pretty well. At the early stages, if you're a founders, you're either building or selling, and it's one of the two. And your hires are either building or selling, and there's not a lot of room for anything else. You're pretty resource constrained, but really it's even less, it's even more so than the resource constrained. It's, you just have a very finite amount of time to see if this is going to work. The goal of early stage is figure out if this is working. And if it's working, then I'll be able to get more funding and put some more fuel on the fire, right? But first you got to build something and then you got to sell it. And if you're not doing one of those two things, you're kind of, you're spinning your wheels.
Yeah, I was kind of curious about maybe doubling down on a concept that you alluded to a second ago, and Justin actually just wrote about this morning, which is that risk profile, right? Like you said earlier, we might miss out on some of those really big deals because of the way we evaluate, but we're willing to take that risk. And then, Justin kind of talked about the in this LinkedIn post, it was this, is there a model that is both investor friendly and founder friendly? And, coming into the space, we thought our goal was going to be, hey, let's combine the two and make it an investor slash founder. And we found that, a lot of models aren't either. Right. So, how are we, and that comes back to the risk profile. Like, what risk are you willing to take as a firm when you're going out and looking at the marketplace and who you're willing to fund? And I think you guys sit in a unique place there.
Yeah, that's a great point. So, somebody told me this early on in my investing career about venture capital. So, I think when you think about traditional venture capital, traditional firms that are much larger now, but I think a lot of venture firms, think about this as sort of for every 10 investments I make, one has to absolutely be a monster return the fund. So the question is, what happens to the other nine? And a lot of them fail. And the venture investor, despite what they're saying, doesn't have the time or the inclination to help out those other nine. And so, because they want to put all their eggs in the basket of the Uber, right, or the Facebook. And so, and that includes funding, right? They'd like to double down on what they think is going to be the next Uber or Facebook. Entrepreneurs say that they agree with that risk, and they're willing to take it, but then when they're on the other side of the nine, it's not a great place to be. We're different. So, we don't have to have a major home run in our fund, but, for every 10 investments we make, 7 or 8 have to be doubles, And so what does that mean? So it means we're very careful with how we deploy our capital, but it also means that every investment matters a great deal to me. And that should be a really good thing for an entrepreneur. or at least a certain kind of entrepreneur who sees this as a partnership, but also, sort of values the investment advice and network and guidance they're going to get from somebody like us. But most importantly, we care. We care a lot about our investments. I know you guys are the same way. That is not really a venture model or the traditional venture model. So that's something you have to consider if you're an entrepreneur. So
Yeah, and I think that's, I don't know. It seems like a no-brainer, right? Like, hey, if I'm getting into bed or in a partnership with, a firm who's going to be a major influence on where the organization goes, and is going to be there in hopefully the good and bad times, as you put it, like there should be more of an index on, from founders on like, hey, I want to talk to folks that have been partners with you and have seen the good and the bad and the ugly, and really kind of index on that caring and that partnership, as you mentioned. But man, still, I just see so often that like cachet is still the number one variable that founders are looking at. Like, hey, I want the recognition, I want the logo, and so on. And to your point, like when everything's good or you're in the early stage of those investments, like that, yeah, that seems pretty cool. But when you start to struggle, as you mentioned earlier, like a lot of these organizations have done bridges. They've had to retool and reforecast models, maybe get to cash flow positive because a next raise is just not possible, and they're struggling at this point. And I think those are the times where you find out that whether you have a partner or not, and all too often when you're in that, like, hey, I'm looking for 1 in 10 to really boom rather than bust. It's just a really difficult spot to be in as a founder and as a team. So I'm not even asking a question. I'm just kind of putting a statement out there. Like I wish more founders would index towards this. But I don't know what the other shoe to drop there has to be. I don't know if you've got thoughts on that in terms of like the conversations you're having with
I think I
founders and
think
organizations.
I think the other shoe to drop is sort of the lack of funding in the environment. I think that's the belts are tightening from an investor standpoint, and their bar for what they want to invest in has gone up. And so as a result, you have to be a lot more sustainable, to get their attention and to get an investment. The question is that a temporary sustainability? If you're the entrepreneur, are you just doing that so you can raise? Or are you doing that because that's the sort of philosophy of you building the business? Yeah.
That's a good point there. Like, what is I find founders always want like hard and fast answers, and the short is like there are none. But what do you see, certainly within your realm? Like, what is growth that gets you guys out of bed and looking at that investment? Like, what's that top line kind of year over year growth that is good?
Well, it depends on the size of the company. So we're investing in companies that are, somewhere between 2 and 10 million of revenue. Usually the sweet spot is probably somewhere in the middle of that. I'd say if you're on the lower end, then you should be definitely growing 100% a year at least. Sometimes more the smaller you are. And then if you're higher than that, it just kind of depends. I'd say the minimum threshold is probably 30%. What we need to see is that if we put a dollar in of investment into sales and marketing, we're going to get X dollars out, you know. And
But that
so
predictability is what you're hitting out there, right?
yeah, some version of predictability that can come in a lot of different ways, but the predictability, just seeing sort of regular growth means this is somewhat repeatable. We can bank on this as we're making bets to accelerate the growth. So
Yeah, and just to kind of underscore again the variability in quote unquote venture capital, like it used to be if you were growing 70, 80% year over year, like that was and to your point, like this is a million in ARR and up, like that was a smoking deal. Anything north of that was great. And like I've run into a lot of firms that are, more on the other side that we've mentioned, like horizontal big bets investments, and you're talking like 3, 4, 10x, year over year growth is like the standard. And so, to the point here, it kind of all depends on the segment that you're aiming at, and then certainly what the ultimate exit that you view as the goal.
yep, that's right.
Yeah, and it gets harder, right? Like I think the connection, the expectations and the risk profile starts to come to the connection to the capital, to the people. And I'm trying to explain this the right way, but essentially, if you have $1 billion fund, there's no individuals that are rounding out that fund, right? This is big institutional capital that doesn't have a human connection. That money doesn't have a human connection to that founder, right? And I know from your perspective, we sat down at dinner when you moved over to Noro, and you're like, yeah, it's the biggest check I ever had to write, right? And same thing for us, right? Like, we got to write a check when we make an investment. So I think that connection of the capital to the founder is one of those things that maybe differentiates how you steward that investment and how you move things forward and how you treat those people. Because, like you said, if it's $1 billion fund, there's no people connected to that money, right? It's big institutional back end. And are you seeing that as maybe a connective tissue piece that you can pull, a string you can pull with the founders?
Yeah, for sure. I mean, for sure. I mean, I think people. I mean, I think this is why, angels can get deals done if they're being very helpful. Angels are early stage investors because
Hmm.
they're tied to the success of the company, and if they're putting their own money in, that's really valuable, and so I think that's some of it is the outcome, and like I said, the sort of 7 to 8 out of 10 have to do well. When it's that way, then you care about every investment, even regardless of how much money you put into it. But it's the concept of ownership, right? So I care about this, I'm acting as if I own this business. I'm acting as if I was the founder of this business because I care that much about it. So the other thing is, if for the bigger funds, if you're investing and 1 out of 10 have to work, you also spread your bets a lot. And so you have investors who have, 5, 10, 20 portfolio companies. There's a practicality for how much you can help your portfolio based on, how many boards you're sitting on, or how many checks you've written into companies. So I think that's an important consideration too. Now, Justin, you brought this up too. I mean, some founders don't care about that as much. They'd rather have the cachet of who's on their cap table.
Yeah, I think that's a point to really underscore, or just a potential question I would put out there to founders to ask. Number one, figure out, and there's a certain point where you can't figure this out, like, but once you've got a term sheet in hand, like, absolutely, like, who would be the partner that is sitting on the board? How many other portfolio companies are they sitting on the boards or advising? Just a massive indicator on to your point, the time that they're going to be able to spend on that investment.
The other thing I'd say though, just to plug you guys for a second, right? So
Please feel free.
well, I mean, most of the founders we talk to are looking for acceleration of growth, revenue growth. Most of them are looking for a pretty meaningful step up investment in go to market. And a lot of them, I was going to say most of them, but a lot of them are looking for help in that field. They'll acknowledge it. They're saying,
Yeah.
please help us think about this growth strategy, think about who to hire, think about, helping us hire that person, evaluating the talent, and then, making sure they're productive. Given all of that, I mean, you guys sit in a very important place, in the funding ecosystem because you guys are, laser focused on go to market, and that's because you have decades of experience combined, in success in doing that. I think that's really valuable. I think you guys, like a lot of operators, you guys have not only have credibility and experience, but you can say, look, I think that's going to work. I don't think that's going to work. Definitely don't do that. Right. And so, I think that counts a lot for entrepreneurs, especially first time founders who haven't been there, done that. So I value that a lot. Sort of, when we're talking about stuff with you guys is, eminently helpful in that regard. And that's what most of our companies are looking for.
Yeah, and to your point, there's a certain amount of lip service that goes in, like, in terms of like, hey, are we willing to admit that? Are we willing to articulate that? And then the third tranche is like, are we really willing to accept that? And I think the admit and accept distance is obviously what we're always looking to close with the folks that we work with, but there's always a learning experience that goes into that on the founders and the team side, because it is an anomaly. When you say that you're bringing a value add, that can mean a lot of things to a lot of different people, and then until you see it day to day and really get comfortable with that, and there's absolutely a point where things kind of start clicking, and everyone's like, oh, I see how this can work and so on, because a lot of times people just haven't experienced that in the past, or they've experienced the opposite, where someone's saying like, hey, yeah, I really want to help you in this area. And this is funny, we run into this quite a few times where it's like people have value add investors on their cap table and they totally have forgotten about it because it was discussed prior to closing, and then it's like, well, I wish we had XYZ. It's like, hey, do you know that you have someone on your cap table that actually provides that service? And a lot of times it would be a surprise to the
Yeah,
founders of their teams.
I mean, this also comes up uh, sometimes in the deals we're looking at. Is there too many investors in the company? And so there's it's not too many cooks in the kitchen. Sometimes it's too many cooks in the kitchen, but sometimes it's the founder can't, or the CEO can't keep track of all the resources he has to help. And certainly it gets confusing when people are saying conflicting things,
Yep.
So that's not really helpful to the founder when you're making it sort of too many things on their plate to try to figure out how to decide, how to grow. So.
That's another good point. Like, just because like we don't lead, we're always syndicating. And so like when we're working with founders and their teams, like we also have to spend a good deal of time, like just aligning with other either board members or investors within the organization, because there is that possibility. Some investors you really don't see until the board meeting. And, everyone wants to add value. So that's where these, kind of big statements get brought out. And there's a propensity for someone to drop this bomb where it's like, great, we've been telling that founder the exact opposite for the last 6 months. So like, yeah, you do have to align there, and it does have to be a proactive thing. I think that's something that we've learned, very much the hard way as well.
I'm wondering on like the guidance. So, we've kind of gone through a few different threads here talking about who's getting funding, the aftermath of the 2020 to 2022 phase, and the different outcomes that founders might be looking for as it relates to the different investors. So we've noticed, and maybe it's just because of where we sit in the ecosystem, that we're running into a lot of bridge rounds, seed plus, extension, this type of thing. What kind of guidance are you offering in that when we're not quite at a huge inflection point, but we need some more capital? How you raise that capital? What are the options? Like, what kind of guidance are you offering that your portfolio when you run into those scenarios? And is it a result of what we talked about, the inflated environment coming out of?
Yeah, I mean I don't know if it's a result of a valuation from an earlier period. I think it's more they haven't gotten to where they thought they were going to go in a certain amount of time. So, in 1 or 2 years, we thought we were going to be at this in revenue versus where we are now, and we're not. And to raise the next round, we think we're going to need to be at that of revenue. So we need to buy ourselves some more time by raising an insider round or a bridge round. I say insider round because, you're usually not going to raise that bridge round from outside investors. Most outside investors would like to lead a round. That's the next stage, once you get to a next level, because they want to see that progression. So the bridge round usually coming from insiders. So an important point for the entrepreneurs is when you're taking that first investment, are they going to have enough money for a bridge round if that time comes? The second thing I'd say about the bridge rounds is, you really got to know what you're going to get from it. You really got to put a plan in place for how I'm going to spend it and what is the results going to be, because that will also be important to the next investor. They're not going to want to know that you took a second round of funding, and still didn't achieve your plan.
Why do you think that a lot of these organizations are so bad at forecasting initially for that first round? Like where are they getting stuck?
I wouldn't say bad. I just say they're entrepreneurs. They're really optimistic. I mean, I think I
It's
mean,
all up and to the right.
yeah, well, it's I give entrepreneurs a ton of credit because they're taking enormous amounts of risk, right? Personal risk, professional risk, sort of to start something, that most data will tell you is a pretty low chance of succeeding, right? So they've got not only a philosophy, but I mean, that's a real risk that they're taking. As a result, they're generally pretty optimistic about what they're starting, right? I think the chances of
Yeah.
success are going to be really high. If they've landed customers in particular and started to see a little bit of flywheel from a revenue perspective, they think that's going to continue and accelerate and grow. And I think that's where a lot of the rosier forecasts come from.
Just add sales and marketing. Sprinkle it
That's
on.
right. That's right.
Yeah.
And by the way, you don't just see that at early stages. You see that at later stages of all sorts as well. We're gonna hire X amount of reps that's 5 times larger than the reps we currently have. And if you just do that math and assume they hit 100% of their quota, then we're good, you know? And so, yeah, that can be difficult.
60% of the time,
100%
it works
quota
every
assumption.
time.
Yeah,
Yeah.
that's a perfect formula. Everyone always hits 100% of their quota.
Yeah,
Exactly.
I think that's where, and this is certainly not every early stage company, so that's what predominantly what we're talking about. But like, if you have a founder that's been through it before, and this is not their first go around, I think they've got a lot more context, or at least I find those forecasts are a bit more informed by, oh wow, I've got to go find actual humans that are willing to put everything into this company and are set up for success to perform, and then coach them and train them, and they're probably not going to perform at 100% even after all of that for at least a period of time.
Not all of them are going to work out, like
Yep.
for reasons that are out of everybody's control, right? So, yeah.
Yeah, I think that for me, that's what is a good indicator of the forecast. Anytime anyone says like, "Hey, this is the size of the market, and if we can go gather 5% of that, this is a $50 billion TAM," it's like, please. And then
Justin, for you guys, I'm very interested in your take right now. I mean, that's also all dependent on your pipeline growing by the same amount or more, right? And so, if you want 3x coverage and you want to grow your revenue dramatically, think about what your pipeline is going to have to be. And then, how are you going to generate that pipeline?
And can those pipeline sources support that, right? Like we run into a lot of times, and I think we're big fans of this, but like, do you have some sort of an embedded cheat, right? Like you have a couple key partners that see you as an extension of their solution, therefore they're referring great deals over. And oftentimes that'll get you from, 0 to, 1 million, 1.5 million, 2 million even. But like, if you're going to go beyond that to the point here, I'm going to add 5 more reps and we're going to be X much more performative. Do those the current sources support that growth? Probably not. They're probably referring what they will refer after you take capital. So, do you have additional partners? Do you have additional channels? Do we know that those channels are predictable and are going to perform? So that's a big aspect. Like what gets you to 1 million is certainly not what's going to get you to 10. So yeah, having those baked in knowledge and assumptions are some big signals to look for, I think.
Yeah, for sure.
Yeah, as you'd imagine, hiring and getting salespeople, as we alluded to, is one of the biggest challenges in these startup environments and people that understand how to sell in a startup. So I actually would love to get all three of your takes. I'm working on an article right now that's like the fundamentals of this, which is the 3 Ps. It's partners, pipeline, and prospecting. And like those are the 3 ingredients that go into building that repeatable, scalable revenue model. And it's crazy. It's really hard to find reps that excel in all three of those areas, right? Like that's kind of, whether it's a sales leader, sales rep, whatever it is, they don't necessarily wrap their head around all three of those things. And the partner thing is one of the biggest offenders. Like, oh yeah, we didn't sell through partners. We don't know how to even communicate with partners. Partner sends over a referral. They never go back to that partner and say, hey, what's going on with this? Like, who are they? What did you do? Like even the simple things like that, right? They don't have the mechanism to do that. The thing that shocks me the most is how just piss poor pipeline management is. Like, say you have, 50 accounts in your pipeline, but there's like nothing that tells you what's happening with that pipeline. There's no management of it whatsoever. And then prospecting is prospecting. Like, I think some people are better at it than others in certain realms. But regardless, there needs to be some mechanism for what prospecting is in your organization because it's not a one size fits all, right? So yeah, I'd love to get all of your takes on that because that's where my head is right now on the topic.
I'll let Justin and Sean go first as the other experts in the room. So
I think, if you're talking through a B2B vertical SaaS, which I know you are, the biggest differentiators, I think, for me in finding those individuals are, have they, worked without a parachute before? Because if you have grown up in an organization, and this can be fairly early, right? Like Series A organizations, like some of them have a couple channels figured out, and they hire SDRs or AEs to, you know, to run down those pre-existing channels, and that they're not building the airplane as they're flying it. And so when they get into this new environment, they're not used to dealing with partners as you kind of frame it, or maybe prospecting across multiple channels and really getting pragmatism is probably the fourth item there. But they're used to doing one thing, and that one thing worked, and that's what they're going to bring that into this new environment. And that's a pretty big differentiator as I see it. Folks that are, I'm dealing with a new hire in this regard at one of our portcos right now, coming in there, really learning, like someone that digs in, like with existing customers, and is like, why did you buy? Where did you find them? What made their solution compelling? And just kind of really learns about what's working for that buyer and what they care about, and then goes back and kind of designs their motions that fit underneath those umbrellas that you mentioned. Those are the folks that I think work out really well. They're rare because there aren't a ton of folks that have done that and achieved some degree of success in building that airplane. But I think that's certainly what to look for in kind of that head of sales, for founding AE, someone that's going to have carry a bag, but also have a hand in really designing what that team looks like ultimately. So I think that's kind of the differentiator as I see it.
Yeah, I mean, when you think about like sales archetypes, you've got someone who's more focused on data. You've got like your cowboy. I kind of think there's like this. The one that's not as common is like a pioneer. Like someone who's like willing to go explore, figure things out, and then they document those things. And so, I think it's kind of like, if you think about maybe 2005, 2015, maybe even 2020, you had kind of the rise of like inside sales and SDRs and the specialized like Aaron Ross model and all of that. And you had these people that were well trained, and then all those organizations they worked for did really well. And those people, graduated up, and now they're probably likely VPs of sales and whatnot. But that next generation of folks that came in, like they already had process. There's already tools out there to already use. There's already things that were already built. And so like they didn't have to go figure these things out. There was an entire like class of people for like 10 years that were kind of these early stage startup salespeople that like they were talking to everyone. There's all these meetup groups, there's community around it of like how to figure this shit out, because quite honestly, there wasn't really a playbook built around it. And so like all those people are now running sales organizations, and we're trying to find those people that are in the middle who have done some of this, but have also built some of it. And so that's kind of hard to find, because you had to be really at a successful organization to see those different stages of it happen. So I think they don't exist, or they're not that many of them that exist. And so some of it, they have to build it while it's happening, but they've got to be hungry enough and kind of have that explorer mentality to go figure it out. And they're going to want to have some pain involved as well, because it's not easy to do. There's a high reward risk factor, but I think there's a personality trait there, and then there's just straight hustle that needs to come out of it.
Vasant, anything to add there in terms of what you see as early, successful early hires in go-to-market or sales?
no, I think you guys hit the nail on the head. I mean, early sales, or sales at an early stage startup you're still wearing a lot of hats. I think, Josh, when you described what that person is going to do, at a company that's 25 million or 100 million of revenue, those roles are three different things, right? Three different types.
Right.
And so I think at early stage, you have to be willing to wear multiple hats. I think to be successful at it, you have to be what Sean says, which is pretty scrappy. And then, to land deals, I think what Justin said, you really have to understand your customer really well, and be really curious and sort of understand their pain points to deliver a solution that matters. So when I say all those things and listen to myself say all those things, that's pretty hard person to find. Oh, by the way, we can pay you a fifth of what you were earning.
Yep.
Right. Like, so, how many people can do that? Right. So I think that's pretty challenging.
For sure. Yeah, that's a huge underscore there. I think the only other thing I would add to that, Josh, is I think I've mentioned this a couple times to you guys and in writing, but like I saw Chris Deegan speak at Rosenberg's Scale Ventures Summit, and the most interesting thing that stood out there. So he was the first, really first sales leader, first CRO at Snowflake before they had even commercialized, and he stepped into the business and said, like, I'm not going to sell anything for the first year. And of course, they weren't really even in market, so that worked. But he just spent a year going out there and talking to the ideal buyers of that solution and figuring out like not only how to sell to them, but what the gaps in the market were. And then that feedback got taken back to product, and obviously they had massive success once, since they launched. But like I think what I take from that is like the conviction to say like, this is what I'm going to do. And, this is how I'm going to build this ultimate go-to-market motion. And when we see people that have some conviction in that plan and don't come with the regular like, well, here's my 30, 60, 90 plan for the first 30 days. I'm going to like evaluate, and it sounds cookie cutter and it sounds off the shelf. Like someone that like really has conviction, I think is the other aspect that we look for.
I would say, back to what Sean was saying too. I mean, we're looking for we're looking for sales leaders that kind of mirror an entrepreneur and their ability to get things done quickly, to make decisions very fast, right? We know everything, not everything you decide to do is going to work out. This is early stage venture, right? I mean, venture capital at any stage up until a certain point is high risk. So a lot of things you try are maybe, hopefully not a lot of things, but certain amount of things you try are not going to work. That's fine. But then you can't hang on to it as a strategy for 6 to 9 months, right? You got to figure stuff out really fast, because that's the only way you survive in early stage. And then once you find something that works, you can double down on it. Oftentimes I see early stage companies, that's not just founders and CEOs, but their management teams fall into the trap of they're really scared. And so that scared of making decisions, scared of making tough decisions, scared of moving on, that's from strategies or people or whatever. But what happens then is that they're just prolonging the failure of the company. And
you've got to trust your gut.
Yeah.
Hey, I know.
Sorry, I was going to one other thing before
Good.
we wrap up here that I think often gets overlooked, especially if you're an early sales hire, reporting to a founder, which oftentimes you are, is the ability to deal with founder thrash, meaning you listen to and believe everything they say. If you do that, you're going to find yourself in a world of hurt. And that goes back to the conviction thing. Like you have to be convicted in what it is you're going to do and that process that you're going to deploy. Because if you just act on every whim of the founder, you're likely going to just find yourself nosediving somewhere.
There's definitely got to be a lot of trust both ways between the founder and that first sales hire in particular for that to work.
So I know we are getting tight on time, but Vasant, I'd love to know, like, what are you most excited about, kind of within the markets and the verticals that you guys play in? Like, what's knocking your socks off these days?
Yeah, I mean, we're vertical agnostic, and we look at B2B software and tech-enabled services of any sort. We like when there's sort of a really good macro trend driving sales, but then the company has a really good product. And so, the combination of the two is really strong, and growth is a little bit scarce out there now. So I think you're seeing more of the companies that are doing well because their product is really needed in the market, and the timing is right now in terms of demand. And I think those are really exciting to us. One of the things we didn't talk about is kind of how long the CEO is going to be selling. The founder or CEO is going to be selling. Personally, I like founders and CEOs who are selling or always selling, selling for a long time, right? And so, to see a founder CEO who they themselves are good at selling, even if they've got a head of sales or a good sales team or whatever, that's really attractive to me. It means they've still got a good handle on their product. They've got a really good handle on their customer. And so, and they're sometimes, the best seller at the company because of all those things, right? And so I think that's attractive to me. It also means they're probably going to have a good handle on sales, in terms of how sales is doing as a department, as a strategy. And that's important to me as an investor too. So.
Yeah, to that point, like I love that. Like once you bring in a team, assuming that's in place, like I love founders that are BD, because it's such a black hole of non-production normally within most organizations, and like founders can hopefully keep a wrangle on that stuff. Like they aren't going to pursue stuff that's just an NDA or a logo or something like that. Like it's going to have real traction from the sales side, and so that's how I love to see that manifest.
And Justin, I have a question for you. What are those books in the background? Is that like the World Book Encyclopedia with a bottle of barbecue
Those are my
Every
so this
time.
has probably been on like 12 podcasts, but like those are my wife's World Book encyclopedias that she
They are the
refuses
World
to.
Book
I
Encyclopedia.
tried to throw them out multiple times. I put a blanket over them. She catches me every time. She's like, "Our kids are going to use them." I'm like, "Our kids are
They
Googling
are.
it at age 5. Like they're never going to use these books." But yes, they're
Is
the
that
bane of my existence.
is that a bottle of hot sauce next to it? What is that in the background?
No, those are just like the whole room is like black and white as a theme. So like they're just little decorative knickknacks.
It makes you look very studious with that giant
Indeed.
bottle in the background.
Uh-huh.
It's combo, good combo.
Yeah, there's like, tons of crap in this.
He
this
reads
room.
by candlelight at night.
Uh-huh.
That's how he fools everyone into believing he's an intellectual.
That's right. I'm just trying to, adopt the title of Count.
Count Gray.
Leather-bound
that's
books
good.
and rich mahogany.
That's right.
Yeah.
Beautiful. Well, Vasant, we want to thank you for joining the show. It's awesome to have you. Always good to see you. For those of you listening for the first time, please, please, please like and subscribe. It helps us boost the visibility of the show. For my normal basic friends, Justin and Sean, thanks for being on as always. For my very special friend, Vasant, appreciate having you.
Great to
And
be on.
that is another episode of The Cheat Code and Friends.
Thanks, guys.